If you've got a core multi-asset fund, can it work as well in defined benefit as it can in defined contribution pension schemes? Is that a serious challenge facing diversified growth funds? This is Institutional Masterclass with me, Mark Colgate. To talk through the issue, I'm joined by three experts. They are Mark Parry, Senior Investment Manager at Aberdeen Asset Management, Aniket Daz, Vice President at Redington, and Robert Holford, Senior Consultant at Spence Johnson. Diversified growth funds have been developed in a world that's been predominantly DB. As you look at it, can they work in a DC environment as well?
I think diversified growth funds are quite well suited to the DC environment. Firstly, the greater outcome focus that brings. So setting something like a cash plus 5% target or a CPI plus 5% target, having an outcome focus is definitely on the minds of DC investors. Also, risk management, that's another kind of element that we can bring in. And while they don't stringently follow volatility targets, at least there's a understanding that volatility is important to most investors. And definitely for DC investors, we think volatility is quite important, especially downside management, which is another kind of hallmark of the DGF brand name. These things are all very well suited to DC investors. The individual investors, the people who are in these funds, do feel kind of downside volatility. They do feel that quite strongly. So I think these characteristics definitely make DGFs quite suited to DC.
But Robert, if you've got something that could be anything up to a quasi-hedge fund, is that a suitable core investment to have in the DC market, which is to a great extent being driven by things like auto-enrollment?
Well, I'm not specifically qualified to comment on suitability, but I think that the way that these are being included into DC funds, there is a significant amount of governance and oversight that is being placed around them, especially in the trust-based side. So they are going in with consultants' overview, and there's trustee boards looking after them. I think there is a significant challenge in explaining these funds to the investors that are actually getting them. I think that's a challenge that exists on DC specifically for any type of investment. Actually, is trying to make sure that people understand what they're getting. But I think I'd agree that in fact it's a suitable investment for DC, partly because it does give a way to have a more sort of diversified exposure. It does control volatility. There's been some very interesting studies done showing that, in fact, minimizing volatility, especially at the beginning of the DC journey, is key to keeping people invested in it. So I think there are challenges to do with the complexity, but I think that in many ways it is an attractive solution, and it's certainly one that actually. And the question is slightly past. It is being used in a lot of the larger DC schemes currently. We see sort of 70 or 80% of the FTSE 100 schemes already have these in their strategies. So the question is not whether they're going to be there; they're already there.
Mark, as a fund manager, does it worry you if there's techniques you're using that you can't explain in layman's terms to somebody who's your end investor?
I completely agree. The good news is that we don't do that. Everything we own is transparent, everything we own is liquid, and there should be a high degree of predictability as well. You should be able to look through to every line item in one of our portfolios, understand what the economic exposure is and what's likely to happen to it. So we use derivatives, but only for risk management purposes, be it gaining or hedging exposure. Every single line item you can look through and identify a thing that's in there, a real security. And I think that's really important. Opacity and the fear that it might engender can't be helpful to anyone investing for the long run or the short run.
And you were saying, Robert, there are some complexities in DGF, so there might be some issues there, just how it merges with the DC market. Have you got any examples there, I suppose?
I just think to the extent that you can't have that level of look through with some of the more complex strategies, or at least that there has been difficulties explaining that level of look through, that those complexities do present a challenge in the DC market. On the trust-based side, we've seen a reasonable amount of white labelling, where trustees are actually putting these into white label products, whereby it's really the trustees that have to understand it, because the end investors are more sort of looking at a white labelled fund, so they don't see the underlying pieces as much. But I think generally speaking, transparency is a key driver of the DGF market, and especially in DC, and it can't really be underestimated to the extent to which that is important. I think I'd also add that within the DC market, one of the things that makes DGFs quite attractive is that they provide a tactical sort of asset allocation element to what has been traditionally quite a static, strategic sort of lifestyle option, where you're moved in quite a sort of mechanistic fashion into bonds and cash as you get older, and the DGFs really provide an element of ability to really have a tactical element to that in what is, after all, overall 30-year journey. So I think that they're solving for a key problem in that as well, and reducing the amount that trustees have to do that themselves within the DC environment.
Well, okay, I mean, if DGFs are doing their job really well, what role does it leave? I guess partly for trust boards, but also for consultants. If you know what, it all goes into a central fund and it's well run, risk management's great. It's not going to strip a whole layer of people and cost out of the pensions industry.
It might reduce the workload of some sort, but a key critical aspect of this, especially as you get towards more complex strategies, is in monitoring the investments. So when I talk about the vigilance of consultants, it's around actually monitoring the managers quite tightly. So there needs to be quite a rigid framework in terms of understanding the strategies, because sometimes the end clients are not going to understand the strategies. It's your job basically to know those strategies inside out and to understand that the trades that the manager's putting on are sensible and are well risk managed. So I think there's always going to be that level of work for a consultant. Some consultants currently do more work around kind of tactical asset allocation. That's not something we do at Redington, but some other consultants do this. Maybe that element of work might disappear somewhat in the DC context, but in terms of monitoring these managers, that job stays the same.
And Mark, is there any difference between running money for DB and DC? I was thinking particularly if you're buying things like alternatives that are illiquid. I mean, in a DB, I guess you could probably sort of buy into more illiquid things, whereas in DC, the money can move around quicker?
I think what matters to us is the outcome. So we have a range of risk-graded offerings which have different core weightings in equities, for instance, different risk and return profiles. And how we go about achieving that depends more on the market background, on valuations of various asset classes and their relationships, rather than the end user of the product. I'm not here to dictate to people what they should be doing with our funds. It's for them to make those choices, realising what the very clear risk and return characteristics of those are. I think one place where we do face a challenge in any of our vehicles is in the property sphere, because clearly that does have a different liquidity cycle naturally to many listed investments, and REITs is one area that's already been debated today. There are a variety of challenges in accessing potentially useful and appealing return streams because of liquidity constraints, because of the need to be able to actively manage all of the components within our portfolios. It may be therefore that we can't get the return out of property that we might see. We'll have to find it from somewhere else.
So is that a real, you mentioned property, is that a real thing? In an ideal world you might say, I wish we had more in property, but we can't? We
have a meaningful exposure to it and we're able to access that, that's great. But we recognise it just behaves slightly differently in terms of its investment cycle to other asset classes. So that's a kind of constraint that comes with it. I don't think anyone's yet created the perfect instrument for accessing that, but that's because of the fundamental nature of the property market, where it tends to be chunky, it tends to have a different liquidity cycle.
Okay. You find that when you're talking to managers, actually you have to spend quite a lot of time talking about what these sort of risk-reward trade-offs are around issues such as liquidity.
Yes, I think all managers, especially in a kind of daily dealing framework, they have to be very conscious about the liquidity. Managers have been using what liquidity budget they have in order to get some effective diversification, but you have to be quite conscious, and we like to see managers very conscious about this and not venture, especially into areas where they don't have the capability. They're kind of new in it. We don't really want them experimenting in areas which they're not familiar with. So the risk-reward trade-off is definitely something that we're looking for, but also the capability in these new asset classes is another thing that we're quite aware of as well.
But I suppose if you don't try something out in real conditions, you never know if you're any good or not. I mean, Mark, if you come across a new investment, do you have a sort of Aberdeen lab that's tucked away in a corner with some Aberdeen money and you can work out what something does? Or it must be quite uncomfortable to think this is the first time we've done that. It's quite exciting, but we're doing it with somebody else's money.
No, it's the money of our clients is entrusted to us. It's very clear, that relationship, so we don't play with this stuff. If I look at our investment into infrastructure, for instance, we recognise this as an opportunity maybe sort of 6 or 7 years ago. It's something we monitored, it's something we started to engage with companies and do our manager research with. Even today, we have a significant investment in infrastructure that's built up over time. But every company that we invest with has been carefully chosen and is carefully monitored. But we are mindful of it being a relatively immature market sector that's yet to be tested in more challenging environments, so we have limited our exposure to it. So I think there are opportunities there. I'm not a great fan of the emperor's new clothes. I'm not a great fan of buying sort of, last year's story next year. Just because people come and knock on your door with a brilliant new product doesn't mean that you should jump at the opportunity, but at the same time we need to be mindful and thoughtful about potential new investment classes that are out there, but not be blinded by the novelty factor. Ultimately, they need to achieve something which is a combination of growth and diversity. Otherwise, there's no point investing in them in the first place.
No, that's the point I was trying to get to, which I think is the one you've made, is that if you see something you want to invest in but you've not done it before, you have a process that limits your enthusiasm to it.
Yeah, I think
whatever
being sceptical is not a bad standpoint, but we don't want to be so cautious that we avoid the opportunities out there. But does it make sense? Is it fairly priced? Can we get out of it as easily as we can get into it? All of these things matter. The good news about financial markets generally is you have a variety of different users doing different things in the same asset classes at different times. That's what gives you liquidity. The concern would come potentially when there's a huge entry or huge exit into something that's still relatively small, and I think avoiding those crowded trades just makes sense from a risk management perspective.
Robert, are you seeing any evidence, given the great, I suppose, variety of instruments and things that you can put into these funds, that they're becoming more like fund of funds? People are buying more and more expertise from outside.
There is definitely a trend for managers to buy in sort of expertise in asset classes where they don't necessarily have, and indeed some of the strategies, especially some of the consultant design strategies, are structured in a much more fund of funds way with strategic allocation and then allocation to separate managers underneath. I think that introduces a new level of complexity to some of the DGFs. Certainly from the monitoring of selection, you have to develop fund selection capabilities, you have to develop monitoring capabilities. These are things that consultants have had for a long time, and if you're going to do it within your DGF, they expect you to be able to do it well as well. So I think it does introduce a level of complexity. It does give you access to potentially extra asset classes, and there's a certain best of breed argument for that. But I think it is something that is very much done at the sort of asset manager level, deciding where they have expertise and whether there's significant benefit to including the asset classes and whether they want to go down that road.
And does it, from what you've looked at with the market, does it create a significant addition in cost? I know you said that the average price of DGF is roughly 70 or 75 basis point.
We haven't seen it increase the cost in terms of looking at the overall cost of these. They're still within the range. Actually, and within the funds themselves, I'm sure it does have an additional cost for the managers. And I think that some of the strategies that use third-party managers for some of the alternative asset classes would tend to be a bit more passive, maybe in the more sort of traditional asset classes, shall we say. So we see a mixture of passive allocation to tracking strategies in equities, and then use of external third-party managers for some of the more esoteric asset classes. So I think the costs stay about the same, but they're blended and executed in different ways in order to produce the same overall result.
We're almost out of time. Mark, Parry, can I just get a final thought from you on what the opportunity and perhaps the challenges are for diversified growth funds, particularly with the DC market?
Well, I think going forward, we're not going to get a repeat of 2013 into 2014. It's going to be a year of economic progress, but a year in which markets will struggle to match the performance of last year. So within that, I think the need to manage risk when you're seeking return is really important, and we hope that focus on outcomes delivers returns for our investors.
We have to leave it there. Mark Parry, Aniket Das and Robert Holford, thank you all very much.